Welcome on board Ed Yardeni. He joins in right now to talk about the US CPI print. Ed, hi, good morning and good evening to you. The Jan CPI data, it's risen about 6.4%. The markets were anticipating 6.25%, higher than the market anticipation. It's a different thing that equity markets overnight have completely chosen to ignore the data point. What's it telling you about the trend ahead?
Well, I think the data was pretty close to expectations. And I think that there's still a perception that the Federal Reserve is looking for a restrictive level of the Fed funds rate, and then they're going to keep it there. So I think what the inflation news confirmed is that once the Fed gets to where it wants to be, and everybody seems to agree at this point that it's somewhere around 5 to 5.5% on the federal funds rate. Once they're there, they're going to keep it there through the end of the year. And I think the market's concluded that the economy can live with it. Economy's actually been growing. You know, we've been debating soft versus hard landing, and right now it looks like no landing.
Ed, the narrative on the inflation is still quite dim. But if I frankly look at the bond market and the equity market, and even the dollar index, these three basic indicators, which in a sense are near-term mood indicators, last night ignored the uptick in the US inflation data. So from an equity market standpoint and a bond market standpoint, is inflation an old story?
Well, I don't really think it's an old story. We're definitely going to be very anxious once again once the February data comes out in March. So I think we're going to all be looking at these numbers very carefully. And I don't think we want to be too confident that we're not going to have some problems along the way where inflation might be higher than expected. But generally speaking, I think the Fed's going to be focusing on what's called the consumption deflator, the personal consumption deflator, rather than the CPI. And I think that news will be out in a couple of weeks. And we know that the December consumption deflator was up only 5%. So it's not going to, I think the next area is 3 to 4%, maybe by the end of this year. And then the following year, maybe 2.5 to 3.5%. So I think everybody's kind of concluded that it's going to take a while to bring inflation down, but the Fed may actually have it right.
And just to summarize with one final question, what is the bigger worry for the world? Is it recession or is it inflation? Because they both cannot coexist.
Well, there's a perception that the only way to bring inflation down is with a recession. Historically, that's been the case. But I think that in the United States anyways, the reason we haven't had a recession so far is because we haven't had a credit crunch. The credit system is actually very strong and has been able to deal with these kind of interest rates. I would say that we've seen goods inflation coming down dramatically. And I think we will see the services inflation rate come down in the second half of the year. So I'm in the disinflation soft landing camp, and I think that's still a plausible scenario, recognizing that there's alternative risks.
Appreciate your time, Ed. Thanks very much for putting those numbers into perspective and your expectations as to what the US Fed could likely do.